Okay, then they've asked us to put together the balance sheet at the end. All right, well, from above we already know, we just know that cash was the $39,000. So let me grab the cash. Okay, then I'll slide back down. It might make sense at this point to hide this. Let me do that. Give us some real estate. Yeah, now we get a little bit more room to work. Okay, after cash, accounts receivable went to 41.6, right? So let's drop that in. That's accounts receivable. And that's it, I think, for current assets. Then they had a long-term one, right, of investments. It was 32, but then we sold an amount, so that's 32,000, and we sold investments of 17,000. So I'll subtract that. Gives us 15. Oh, but there was a gain of 3,400. So the 17,000 was the cash amount, but if there was a gain of 3,400, then really the book value was the 17,000 minus that 3,400. Okay, you guys see how I'm coming up with that? So investments at the end of the year really is 18,400. Okay. After investments, plan assets, not sure we had any change. Yeah, we did. We sold something. Okay, so plan assets are our long-term assets. You could call them property, plant, and equipment. They started off at 81,000, and then we had a sale we had a purchase of land. We'll do that separately, but we had a sale. Oh, I'm sorry, we didn't have a sale. All we had was depreciation. Minus depreciation. I think 12,000. Let me make sure that's right. Yeah, that's correct. So all we had with plan assets was the depreciation on them. So we have the beginning less the depreciation. There was no additions, no sale of them in this problem. And then land, of course. And land started off at, I think, 0. No, we had 40,000. And then we purchased that 30,000. So if we add that together, we have 70. But I'm missing something else here. Wasn't there? Yeah, land was purchased through the issuance of bonds. Now that's a non-cash transaction in number 7, but we also have to add that in. So let me add in the bonds as well. Number 7. Plus F, something's not making sense here. Let me take another look. It's number 2. A tract of land was purchased for 18,000. So we've got the beginning land, then the land that was purchased through the issuance of bonds, and then we need to add in the 18,000, 88,000. And once we have that, we have our total assets. So I'll sum that. $256. Okay, now let's take a look at the liabilities. Accounts payable was the first one, and it remained at 30,000. So we'll drop in the 30,000. Long-term notes payable is next. I'm just going to copy that and drop it in there. And long-term notes payable was 41,000, but we had a change. 16,000 was retired, so we better subtract out that. So we'll take that 41 minus the 16,000, and if I slide up, that gets us to 25,000. Okay, then we have bonds payable, and we didn't have any to begin with, but that we issued 30,000 in bonds to purchase the land. So we've got 30,000 on our books now. All right, that takes care of all of our liabilities, both short and long term. Let's take a look at capital stock. Oh, this thing doesn't look like it's formatted right. Let me make that consistent. That's better. Okay, capital stock was in the amount of $100,000. And what else did we have? Do we have an increase in capital stock? Yeah, we had an increase of capital stock right there, 24,000. So that takes us up to 124,000. And then our only other item is retained earnings. And here we have to sort of walk the statement of changes in retained earnings in our head. So we'll take the beginning retained earnings, 23,200, plus we'll add in net income. And net income was 32,000. Then we need to subtract out any dividends, 8,200. And that gets us to 47,000. And I think with that, I can copy this formula and we're in balance. How about that? Okay. Just a little bit of analysis at the end. Well, we'll tackle net cash provided by operating activities. Okay, with free cash flow, we'll start off with, let me start here. We start off with net cash provided by operating activities. Now we hid that above, so let me unhide that. I got to figure out which row right in here. Okay, so we'll unhide that. And it was 20,200 right there, so let's grab that. I'll just type it in. And then the purchase of land was 18,000. Okay. Dividends were 8,200. And that's our calculation. I'll just sum this of free cash flow. So free cash flow was a decrease of 6,000. All right, now I want to cover two ratios real quickly. I want to cover the current cash debt coverage ratio, and then I also want to cover the cash debt coverage ratio. In the interest of time, I think I'll just type in what these are. Okay, what you do with the current cash coverage ratio is you take the 20,200 of income from operating activities and you divide it by current debt, which is the accounts payable, right? Which was 30,000. It didn't change. Okay, so that equals a 0.67 to 1 ratio. Now with the cash coverage ratio, we take the same 20,200, only this time we've got to divide it by the average debt. Okay, the average debt at the beginning of the year was 71,000, and I'm going to use a couple shortcuts here. 71,000. At the end of the year, it was 85, right? And if you subtract the 85 is those three right there. Okay, just sum the 30, 25, and 30. And then you would take that divided by 2. Okay, now really you need to put braces around this so that you get the order correctly. And when you do that, you come up with coverage ratio of 0.26 to 1. Okay, just wanted to cover that. Thanks, everyone.